Morning, everyone. Yeah, and I'd like to thank you all for coming. Just to let you know, there is a slight delay in the timing of the presentation, but if you can use the comment box below, we'll pick them up during the presentation or run through them all afterwards, depending on the number of questions we have. Like I said at the start, thanks for attending. I'm Nick. I work with the owner managed businesses here at Robson Laidlaw to help them improve the business. We also have Martin Wardle on the webinar today. Martin's one of our tax specialists here at Robson Laidlaw. And in the background, we've got Gemma just working her magic on the presentation and the slides, and she'll pop back through at the end to go through the questions. So for those of you who don't know who Robson Laidlaw are, we're a long-established firm in the northeast of England, and we're celebrating our 100th birthday this year. We've got numerous skills and specialities across our team of almost 100 people, which means we can more or less help with any business issue that you might find yourself facing.
So yeah, hi, thanks for that, Nick. It's Martin here. So on the screen there, you'll see a quote from the film Jerry Maguire, Show Me the Money. I don't remember who starts it. I think it's Cuba Gooding Jr., but Tom and Cuba shout this at each other quite a lot. Does this resonate with you as a business owner? Is this something that you sometimes wonder, well, where is the money? How many times have you got to the end of the year, your accountant's told you you've had a great year, you made a solid profit, and yet you haven't got any cash in the bank to show for it? So who on here has experienced that moment of frustration? Or who knows that they're doing well, they're very busy, but still have no cash? The session today is about challenging you to become more aware of your cash flow cycles in your business and to do some things differently to improve your cash flow. Through the session, some key principles. First one is, without cash, your business will not survive. Cash is the lifeblood of any. Without cash, your business cannot survive. In fact, very profitable businesses can still fail because of poor cash flow. The second one is, you need to understand your key cash flow drivers. So when a business is growing fast, often in startup mode, it needs working capital to fund that growth. That's why it's called working capital, because that spare capital has to work hard. Every business is having to pay for stock, fund payroll costs and overheads and buy new assets before it gets to the bank. Before it gets to the bank the cash from selling its goods or services. Thirdly, you need to manage cash flow and know that it's all about your business processes. So the fact that the business is making profit on paper and yet cash is tight is precisely why every business needs to understand their cash flow drivers. These are the business processes that affect your cash flow. Processes like how you order stock and pay for it, how you bill for your services, and how you make sure you get paid by your customers, to name just a few. The fourth key principle is that you shouldn't treat the symptoms of poor cash flow without fixing the underlying causes. That's time consuming and frustrating. So many of you here today would have been asked by a bank for a cash flow forecast, for instance, often because your overdraft is blown out. When that happens, preparing a cash flow is vital. In fact, every business should have a cash flow forecast. This should be one of the things you do after you've completed your one-page plan. You should do this annually, and it should be a month-by-month cash flow forecast. It's simply the best practice in business. And just out of interest, if that's something you already do, please just comment and let us know how you get on with that. The fifth principle is that you need to be prepared to make process changes. Being aware of your cash flow cycle isn't all there is to it. Simply preparing that forecast every time the bank asks for one is not going to fix the underlying causes of poor cash flow. Borrowing more money from the bank is simply not a long-term solution. And of course, it costs you interest and takes time to do. That time would be better spent fixing your underlying issues. And now back to Nick.
So on the screen there, what you'll see is the agenda for the webinar today. I'm not going to go through each one and read them all out to you because I'm pretty sure you can do that yourself. But one of the key things that I want to explain here, if there's something that you can take away from today, it's that you need to take some sort of action. If you don't take any action from anything that you pick up today, nothing's going to change as a result. So without further ado, let's explain the difference between profit and cash. So who here actually reads their financial statements, their accounts from their accountant? And you can be honest, it's okay to admit that you don't read them. And as I suspect it's not many people, a lot of you are going to go straight to the bottom line. How much profit have I made? How much tax have I got to pay? But if you don't look at them and you don't understand them, you're never going to get a real understanding for what the difference is between the profit and the amount of money you've got in your bank. And to put it as simply as possible, profit is the remainder of your income once expenses have been deducted. This doesn't mean it's the amount of money in the bank. It's not the amount of sales that have been paid for. It's not the amount of expenses that have been paid for. It's the income generated in a period, less expenses deducted relating to that period. And as an accountant, the accounting principles remain there, and you have to account for expenses when they are due. So if you get some work done, but you haven't had a bill yet, or you haven't paid it yet, that expense is still accounted for. Obviously, that's not going to affect the cash flow until you pay it. So just as an example here, on the screen, what you'll see in the box is 7 different items that you'll all see in your accounts. Now, there's 2 boxes, profit and cash. What you can see clearly is what it affects, whether it affects your profit or whether it affects your cash. What's important to know here is a profitable business can fold, it can go out of business because it doesn't have cash. Similarly, a business that's making a loss, so it doesn't make a profit at all, it makes a loss, can still survive because it's still generating cash. So let's just go through this table here. The payment of your VAT, it doesn't affect your profit, but it's a payment you've got to make from your bank every quarter, every month, every year, depending on what scheme you're on. Loan repayments. Now, when you repay a loan, the capital element of it is not a profit expense. The interest is, but the amount you pay from your bank isn't, as you can see there. Cash that you spend on assets. So if you need to buy some new machinery or a new van or some new computers, for example, they don't affect your profit. They go on a balance sheet. So your profit will look higher than you expect if you're thinking you're buying those assets and reducing your profit. Similarly, cash received on the sale of an asset. It doesn't affect your profit. That goes directly into your bank account. And depreciation. So depreciation is an accounting estimate that we make in your account that helps the accounts reflect the true market value of the assets that you own. This is just an accounting estimate. It affects your profit, but it doesn't hit cash. I'm now just going to talk a bit more about the profit versus cash in the working capital cycle.
Yeah, thanks, Nick. So, for example, if you're a service provider, you have a working capital cycle that is basically as follows. You sell services to a customer. Once you've invoiced your customer, that amount increases your accounts receivable total. It's money due into the business. That's what your customers owe you. That money isn't in the bank yet, though, until you get paid. So basically, the simple cycle for a service provider is you raise an invoice, you in theory have a profit, but of course you have no cash at that point. That's probably the easiest way to demonstrate the difference between an accounting profit and cash in the bank. Of course, some businesses aren't that simple. Their cash flow cycles aren't that simple. So for instance, if you're a manufacturer, you might have a cycle that looks like the right-hand side of the screen. So you make some goods and you purchase stock and materials to make those goods. You might have to pay some suppliers immediately, others might give you until the 20th of the following month to pay or something like that. You then manufacture your goods, and at any point in time, you'll carry out work on the progress or stock of unfinished goods. Once you receive an order for those goods from a customer, you make a sale. You invoice that customer, and the amount of that invoice is now in your accounts receivable ledger. Again, that's money owed to you. You have to wait for the customer to pay you before it's actually cash. So as you can see, that takes some time, depending on the type of business, to convert whatever it is you make, to make the thing you make, or whatever the services you provide into cash. To understand the cash flow effect of this on your business, you need to calculate your cash conversion cycle. So let me show you what I mean by that. So let's take a look at a real example, a wholesaler. So a wholesaler buys stock from suppliers and has until the 20th of the following month to pay for that stock, which is, let's say, an average of 35 days. Of course, you need to work out these figures for your own business and we can help with that. But in this example, it's 35 days. So on average, this business must pay suppliers 35 days after buying stock. They aren't able to sell the stock the moment it comes into business. They've got to put it on the shelves, they've got to put it on their catalogues, their websites or whatever. So some stock will sell quickly, other stock will take longer. And eventually some stock sits there so long it has to be discounted to get rid of it at all. On average, let's say this wholesaler holds on to stock for 65 days. And when they sell the stock, they provide credit terms to their customers. But of course, this is the real world, so not everyone complies with the credit terms. And they've worked out that on average, it takes 45 days to get paid from their customers. So we can work out the cash conversion cycle of this business by using the 65 days average stock holding time, plus the 45 days it takes to get paid by customers. But you have to deduct the 35 days that their suppliers allow them to basically pay. So from the point where they pay for goods to the point they get paid for goods is 75 days. So this business has a cash conversion cycle. So hope the shorter the cash conversion cycle, the better the liquidity or the cash available in your business. If you're a manufacturer, wholesaler or retailer, you'll need to know what your average supplier payment terms are in days, what your average stock holding is in days, and what your average debtor days are, how long it takes to be paid. Now, if you're a shop that doesn't provide any credit at all to customers, the day the sale happens, you'll get paid. So that's handy, that's nice and easy, but most businesses have something a little bit more complex. If you're a service provider, the cycle you need to know is the average supplier payment days and terms and days, the average work in progress days, how long does it take you to deliver the service, and then again, how long it takes you to get paid. And unless you know these things, it's very hard to work out what your cycle is, and it's very hard to then look at the underlying issues. So hopefully that makes sense. Any queries, again, just put them in the comments, but over to Nick for a worked example.
Perfect. So let's say you've calculated your cash conversion days. What is the impact on your actual cash flow? What sort of things do you have to work on if you want to increase the bank balance? Now, I'd like to say this won't be complicated, but I can't make any promises. What you'll see on the screen here, on the left, you've got some key figures that's been extracted from a set of accounts. And based on the three things Martin's just described, we've got our debtor days, our inventory days or our stock holding days, and our creditors days or our payable days. And in this example, that calculates out to be 76 days. Now, initially, we'll start off with those 76 days, but we can focus on different areas. So on the screen here, we focused on reducing our debtor days, which means we are getting our money in off our customers quicker. And if we can reduce those days by 9, in turn, we also increase the rate that we sell our goods by 6 days on average. The impact that would have on this particular business is they would have more money in the bank by £52,685. What's key here is you haven't made any more profit. All you've done is got money in your bank quicker. So these are the sort of numbers that we can help you identify in your business and help you work towards reducing your overall cash conversion cycle. But like I alluded to at the start, you can't achieve this without doing something differently. And to do this, you do need to have a plan in place.
Basically, there's 4 key actions you need to take. The first one is understand your cash flow better. Hopefully this webinar will help. If you've got a lot more queries, which you probably have, just get in touch with your normal account manager. We'll be happy to go through this further, or contact myself on it. But basically, you should start by preparing your cash flow forecast. And you should also really build this into making it part of your annual business planning. So if you do this at the minute, it would be great to hear. So put something in the comments and, again, let us know what you get from that. And this is, to be fair, what most of our successful clients do. You don't have to do it to be successful, but it's easier to be successful if you do this. So, of course, the next question is, who finds the idea of doing this cash flow forecast scary? Well, that's okay if you do. First time you can prepare it, it can be very, confronting. It's something that you maybe haven't done before, and it's a skill set you haven't used. But luckily, once you get used to it, you realise that the benefit from it. We're talking here about money, facing cash flow challenges, and those things are important because they won't go away. And often these are things that are ignored. It's the job you never get round to. Once you have your cash flow forecast in place, however, there's a sense of peace and relief that comes with that. When you're sitting and looking at the finished product, you've learned the lessons, you know how to do it, you get good satisfaction from it. The second thing you should do is incorporate or build your cash flow forecast into your software. What better way to do this than if you use something like Xero, which is an online accounting package. That cash flow forecast is then shared with anyone that you give access to. But more importantly, as you update your software, you can see how you're doing versus your forecast. You always hear about people saying, well, I'm up on forecast, down on forecast. This is how to do it. Your forecast needs to be incorporated or built into that software so you can actually get those reports. This enables you to recognise where you are against target, and you learn how to become aware and comfortable with your cash flow cycles and where you can improve them, more importantly. Because if something doesn't happen quite as you thought, that will show you where you need to focus on. So the third thing is to set a cash flow improvement plan. Use SMART goals. If you don't know what SMART goals are, again, we can go through that. But as Nick said, you need to not just know what your cycle is, you have to implement, you have to come up with an action plan. So having the forecast is one thing, but using that knowledge to improve your cash flow is another. That's the key thing you need to do from this. And to do that, you have to understand your cash flow cycle and improve the business processes that can shorten it. So Nick's worked example, if you can get paid quicker or you can hold stock quicker, they are 2 great examples, but there are hundreds that could impact on your business. And basically have to set some goals to see if you're actually achieving anything by changing those processes. And finally, you need to have someone independent to hold you accountable to your plan. If you have someone to encourage, support, and even nag you to work on your business, that is often the fastest and easiest way to get ahead in business. It's all too easy to say, yeah, I'll get round to it, and then justify to yourself that you're too busy or it's not as important as you thought it was. These things are critically important, and if you can't do them, you should look to get someone to hold you accountable. And it should be someone independent. Ideally, it's not your spouse or someone close to you. It should be someone that actually does proper hard coaching and that will hold your feet to the fire to make sure you get these things done. Getting someone soft is soft coaching, which doesn't really help. They'll make excuses for you quite easily. So hopefully that helps, and back to Nick.
Thanks. So there are many clauses for businesses having poor cash flow, but on the screen there, what you're going to see is the top 7, the most common 7 causes for poor cash flow in a business. So number 1 there is a poor accounts receivable process. What I mean by that is it's a poor process from making the sale to getting the money in. That's going to result in higher debtor days, the time between billing and banking. And if it's too high, it's going to stifle your cash flow. The second thing you'll see on the screen there is the accounts payable process. On the flip side of a poor debtors days is you pay your suppliers too quick. You're giving away that cash that your business needs before the supplier actually wants it or needs it. So one way of improving that is to review all of the terms that you have with the suppliers, and you might be able to identify ways to increase your cash flow or possibly, if the cash flow here isn't a massive issue, just to improve the terms of trade that you get with them. Number 3 on that list, you might be carrying stock for too long. It means you've got full shelves, but it means you've got an empty bank account. All that cash is tied up in the goods on your shelf. So this is no different if you're a service provider. So if you provide a service, you'll have what you call work in progress. Work that's started, but it hasn't got through to the final stage of completion to be billed. Again, moving that process along is just as important. Step 4 is an inappropriate debt to capital structure. Maybe it needs to be reviewed. Perhaps your debt should be consolidated and paid off over a longer term. Of course, it's much better for cash flow if you can pay £500 a month instead of £1,000. Or maybe you need to have an honest look at the drawings that you take from your business. The business cash flow profit might not be realistic compared to what you need to survive on. And often significant cash flow and interest charge improvements can be achieved just with the regular review of the existing debt you've got. The 5th reason is you have high overheads. So I recommend doing this once every 3 to 6 months, at least every year though, is reviewing your overheads and review them quite strictly. Do you really need it? If you do, what benefits are going to bring? And if the benefits don't outweigh the cost, it's probably something you can do without. Number 6 on that list there is gross profit margins are too low. So low gross profit margins compared to what your industry average is would indicate that your purchases, your direct costs or variable costs, depending on the terminology, are too high in relation to your sales price. Which leads nicely on to number 7. It could actually be that your sales prices are too low. So let's look at some strategies that we can put in place for each of these 7 areas. It would be good if you can write some comments here. We're going to give you some ideas as we go, but if you come up with any other ideas yourself and you're happy to share them with everybody else, please put them in the comments box. So, number 1, the accounts receivable process. How you can improve this process, how you can improve the billing to banking delay. You can review the terms of trade with your customers. So we have what we call a letter of engagement, which clearly defines exactly what needs to be done by who and when, and most importantly, when things need to be paid by. You might want to offer customers a discount for prompt payments. You might want to bill people faster. Quite often service providers have a long delay between completing the work and billing the work. Making it as easy as possible for your customers to pay you is only going to make things better. If they have to do less work to pay you money, they're more likely to pay you quicker. You might want to fix your debtor control processes. Look at the systems and the processes that you've got in place. Ask a third party to come along, somebody who's objective, somebody not involved with the process day to day, to identify areas where there are weaknesses or improvements to be made. Also, you might want to add on, especially if you use something like Xero, some software that will automatically chase the debts from you. Now, most accounting software does have this built in, but you can get specialized software that does it with an added level of extras. The second cause was the accounts payable process. Some of the things you can do in your business to help improve this. You might want to ensure that the business isn't incurring any late payment penalties. Obviously, if your terms are 30 days and it takes you an average of 60 days to pay your supplier, they might actually be adding extra charges on. Not good for profit or cash flow. Now, I know this is about cash flow, but at the same time, you've got a business to run and profit is also important. If your suppliers offer you a prompt payment discount and you're in a position to pay it, it is worth taking advantage of that as well. So you are going to pay quicker, but you're going to pay less. You should also review all of your supplier agreements, review the payment terms you have with them, any prompt payment discounts, delivery charges. There might be other arrangements in place, like a rebate scheme if you do so much work. Similarly to the debtor process, review these processes to make sure everything's done correctly, that there are no weaknesses, that the way things are done are the most efficient they can be. And review your actual spending against budgets. If you don't have budgets, forecasts, it is important to get these in place so that you can monitor how you are performing. The third one was your inventory process or stock. So some of the ways we can shorten the cash cycle by moving stock faster is you could start to review a stock ordering system. So instead of buying goods when you've got 100 left, you might be able to do that when you've only got 10 of a particular item left. That's less cash tied up in those 90 that you would normally pay for. You could use technology to better manage your stock reordering and manage your slow moving stock. If you don't have a slow moving stock policy, it might be worth getting one. So anything that's over 6 months old, a different option to still generating some cash, whether it's selling it to somebody at reduced rates. Quite often you'll see stock clearance outlets where they're offering up to 95% discount, which I don't think that's strictly true, but that's the sort of thing that they're trying to achieve here. We've also got looking at your shrinkage controls. So this is most important within tech companies. If you buy a laptop today, 2 weeks down the line, in fact tomorrow, it's probably out of date because there's some new technology. Most things lose value over time. So if you're keeping a hold of stuff for a long time, you're losing value straight away, which means you're going to get less money. So you want to start moving things fast. But of course, this does differ from industry to industry. And the last thing that I bang on about is the processes. You need to look at the processes you've got or implement some and make sure they are fit for purpose. Make sure that you've got a policy for slow moving stock, for shrinkage, for obsolete stock, for reordering, and make sure you get the right person to help you do that. Again, not somebody that's going to directly benefit or have extra work to do as a result. Martin's going to talk about the last four, so I'll just switch over to the debt and capital structure. So sorry about that, bit of a technical issue there. So what Martin was going through there is the debt and capital structure. So ways you can improve cash flow on the back of this is to review the interest rates that you're paying. You might be paying fixed interest rates and variable interest rates. It might be worthwhile fixing it or moving them all variable. Review the terms of any loans you've got. Now, are these loans right for the business? Are they achieving what you set out to achieve? Is what you signed up for 3 years ago still the right option today? As I alluded to earlier, review the drawings that you take out of the business and possibly consider new investment by putting in the capital from the existing owners or looking to seek other sources. The fifth most common cause is you've got overheads that are too high. Things you can do here. You can review your overheads annually. So every year your accountant is going to give you a statement showing exactly what you've spent across, let's say, 10 to 15 different key headings. Review these. They'll say whether they went up, down, explain why. Something might stand out that you weren't aware of. Doing this annually, you could save quite a bit of cash and also make more profit. It's a good option to get a better deal with suppliers. So your IT providers, your service costs, phone, website hosting, internet, insurances. There's always the opportunity to shop about, and it might be worth doing it if you're going to get the same service. Do you actively monitor or measure the return that you get from your marketing spend? Is it worth reducing it or possibly putting more into it? How successful is it? There's the option to go paperless. Of course, paper costs money. Most of you's already got tech that can do the same thing. You might want to have different controls in place over expenses between the staff in your business. Most common ones here is any expense over £50 needs to be reviewed by a manager, director, head of line, something like that. So people just can't spend money on anything they want to or think that they need. Again, get your expense budgets in place. So understand what you expect to be paying and make sure that you are actually paying that and not over the top. And review the whole organisation structure. There may be opportunities to offshore or outsource or subcontract some of the work without having additional overhead costs from employment and pensions. The sixth most common cause of poor cash flow is gross profit margins being too low. So a gross profit margin is what the contribution towards the overheads is. It's what the selling price less the cost of goods is. Different industries have different rates. Most people are aware of them. If not, you should do a bit of research to make sure that what you're achieving is what's acceptable in your industry. So the things that you can do here, if you're a manufacturing business or service provider, you want to reduce the rework, the duplication, how many times you do something or how many times have you got to fix errors, what time is wasted in transporting goods from one area to another. Now that could just be the communication method if you're a service provider, such as emails versus telephone calls. Improve the overall systems and efficiencies you have. Be able to capture and build time better, especially if you're a service provider. So this is the likes of timesheets. Do you have a policy in place where it's updated daily, weekly, monthly? How onerous is it to record the time on each job? And how well is that monitored? Again, this sort of links with the creditors, the creditor payables. Talk to your suppliers and see if you can get discounts for prompt payments. It might increase your cash conversion cycle, but there's going to be trade-offs between the profit and cash flow that you need to consider. And the final one of the 7 was that your sales levels or sales prices are too low. So things you can do here, these are quite often the easiest things to do because you have a lot of influence over these, is increasing the customer retention rate. Make sure that customers are happy and that they don't go elsewhere. Generate more leads. Are there avenues that you haven't tried yet? Why not give it a go? Of course, monitor it carefully because you won't know if you don't monitor it if that avenue has been successful or not. Increase the conversion rates. So a conversion rate is from a lead to a paying customer. Increase the transaction frequency. So there are apps out there that will do this for you. So if you have a customer that comes once a month for a haircut, is there a way to increase that frequency to once every 2 weeks or 3 weeks? And also increasing the transaction value. If you notice supermarkets, for example, they've got a whole aisle on sweets where you can buy 4 Mars bars for £1. You get to the checkouts and they've got 1 Mars bar for 70 pence. And that's there in the hopes that you'll just pick it up and they've just added a little bit to your transactional value. Is there anything like that that you can do in your business? But this isn't an exhaustive list. There's literally hundreds of ways you can increase sales, and all of them come under one category here, that your sales levels are too low. So one of the other things that I want to talk about here, sort of a real life example, is the bounce back loans that the government's been giving out. Great, the government's done a lot to help everybody over this current situation. And a lot of people have got these bounce back loans of up to £50,000. Now this bounce back loan won't affect your profit, but what it will affect is the balance in your bank. So this is most important or most relevant for limited companies. So a limited company, you can only pay yourself dividends if you've got profit to do that. So you might be a business that's not making a profit, but have got money in the bank. And what happens is if you start taking this money out of the bank without the profit being there to pay you it, it's classed as a loan from the business to you as the director. And if you have borrowed money off the business, you have to pay additional tax on that of 32.5%. So if you borrow £50,000, you're looking at about £16,000 worth of extra tax if you've taken that personally without the profits to attribute it to be able to take those dividends. Now, that's just one key area that I don't want anybody to fall into that trap. And it's the reason why profit versus cash flow needs to be a bit wider educated so nobody else does fall into this trap. Any questions on that, or you think you might be falling in that trap? Management accounts, bookkeeping software, or just giving us a call to see how we can help you with that. Perfect. Keep you out of trouble. So what are the next steps here? How can we help you? So we can help you prepare cash flow forecasts starting from £850. So the price indicates it's not a quick thing to do. There's a lot of things to consider, and depending on the complexities within your business, all depends on the price. But it is an important thing to have. If you've got a cash flow forecast, or if you know cash flow in your business isn't particularly great and you want some help making it better, we can also offer you some cash flow management coaching. Going through some of the things we've talked about today, as well as other stuff, to help reduce your cash conversion cycle and get more money in your bank. That's the key here.
So, hi there. Hopefully you can hear me this time. Apologies for that, lost my connection. What are the next steps then? So there's been a lot there, and I do appreciate that. Again, pick the phone up, have a chat if there's anything you're uncertain on. But basically, there's a couple of things we need you to do here. So first of all, Gemma, after this, we'll send out an evaluation form. It really does help us to know whether you found this of interest, what you think we could have done better, or feel free just to give us immense praise if you want. We know we need a better Wi-Fi connection for me. That's already on my list. But yeah, so please do complete that evaluation form. Also, let us know if there's any other topics that you want to know more about, whether it's a part of this that we've talked about you want some more detail on, or whether you've just got a different topic altogether. The next thing is you should really identify the 3 most important actions to take. Now, why is this important? How often have you watched a webinar, you've read a book, you've had some training, and you think that's all great, let's do all of that. If you try and do it all, you simply will not do it. Equally, if you walk away without an action plan, without 3 most important things to do, the chances of you doing anything are quite slim. So let's make sure you all have at least your 3 most important actions that you're going to take away from you. Again, share them in the comments if you want, or get in touch and have a chat about identifying the 3 most important. We're happy to help. But what you've actually got here is 4 options. You can either do nothing. And again, that's what a lot of people will do. And that's human nature. You'll think, well, that was all right. That was fairly interesting. But I'm just going to crack on and do what I've always done. The second thing is you might retreat away from actually looking at this problem. You might know you've got an issue. We might have just told you how complex and important the issue is, but actually that just scares you and you're actually just going to run back. It'll be all right. I'll just sell more stuff, or I'll just ring me debtors and get the money in quicker. It's not as simple as that. So the third thing, which hopefully most of you will do, is you'll actually take what we call a normal amount of action. You'll do a couple of things. You'll chip away around the edges, around the easier wins, but you'll not actually get the most out of this. So this is what most people will do, but unfortunately what that will tend to then do is it'll make it much easier for you to fall back into the first 2 options. It's very easy to go from doing a little bit of something to then falling back to nothing or hiding. And the reason for that is it takes time to form habits, and also you haven't got the accountability. You're not having someone hold you to account. So the 4th option is, let's do something massive. Let's make a fundamental change to the way you do these things. And I get it, this is hard, but we are here to help if you want that help. So please, hopefully, at least do something, and ideally do a lot. Just to help you with that, of course, it's worth mentioning that there are funding options out there, and we are proud to work with people like the NAL and Northeast Growth Hub, and most of the other funding providers out there. So you might be sitting there saying, well, that's great. These guys are trying to, help me, but that's going to cost money. How do I pay for that? And of course, one of the classic things here, as we mentioned earlier, is if you can find a way to get something cheaper or subsidized, then that can only help. They change regularly, but we're on the pulse. We know what's out there, and we're happy to share that information with you. And almost finally, just to let you know, we are partners in a global scheme called Buy One, Give One. And as part of that initiative, we are a business that works towards helping the UN meet its global goals. That might sound grand, and you think, well, what can I do to help, or why are they telling me this? But basically, for everyone who's attended this webinar today, we will be donating 6 days of access to e-learning for a child in India. If you can pardon the joke here, I hope their internet connection is better than mine. But yeah, so that's what we'll be doing for everyone who's watched this today. And the final thing just is, if we've got any questions, if anyone would like to ask us a question now, remember, pop it in the comments and Gemma will read out any questions that we've had, and we'll be glad to go through those. Gemma will need to unmute so she can tell us what the questions are.
Hi everyone. Yeah, we asked if anyone had any questions ahead of the session, and we've had 2 in from 2 separate clients. The first question is, my biggest problem has always been raising invoices in a timely fashion, as I'm always out on the road. Do you give any advice for this?
I'm happy to pick up on that. Of course, it depends on what kind of business you are. But again, if you look at I think Nick's first tip of the 7 tips was accounts receivable. And what you need to do is make sure that you're finishing work quickly. And that isn't the point of the question. The second thing is making sure you're accurately recording time or sales. And of course, the third thing is make sure you get that invoice out as soon as you practically can. So there's been some great advancements in software over the last 10 years. To the point where I often say to people, if you're still using the same software you were using 5 years ago, you're probably out of date. If you've been using the same stuff for 10 years, you're definitely out of date. One of the biggest revolutions here is the ability for people who are on the road to literally use their phone or a tablet to create invoices on the fly. So a good example of this is some of the trades that I use happen to be clients. Before they leave my building, if they've been in and done some plumbing work or electrical work, they sit in the van, and before they drive to their next job, they've raised the invoice on their phones. I've got the invoice. It clearly sets out what the payment terms are. And that's great. And I contrast that to some trades I used to use. They wouldn't invoice me at all for probably 6 weeks or 8 weeks. They would wait till they were running out of cash, then think, who have I not billed? And then, of course, they would expect their money instantly on receipt of an invoice that comes out of the blue at a time that the customer can't possibly predict. So it's much easier to get the money in if you raise the invoice. Look at things like software on your phone to get those invoices out as quick as possible. Hopefully that helps.
Thanks, Martin. The other question that we had was, I have used automated chaser platforms in the past, but I have always found that they send people the chaser at funny times of night, or to people that have actually already paid. Is there any other platform that you recommend?
Yeah, I'll take this one. So it all depends what software you have been using. But there are lots of them out there at the moment, and they quite often come with flexibility to select what customers you're going to chase, and you can categorize them. So you can say, right, these ones I want to chase more frequently than others. You also get the ability on most of them to select who the email comes from and at what time and on what days. So for example, if somebody is 2 days overdue, it might just come from the credit controller. However, as this escalates and becomes 2 weeks overdue, it might start coming from management, and then from directors. And you can do this all automatically without the customer actually knowing it's being automated, which I think is the key here. But yeah, so the answer to your question is there are lots of other bits of software out there, but it's about finding the right one for you. And you will be able to get around the fact that it sends them at stupid o'clock in the morning with random email addresses. The one in particular that I'm thinking of is called Chaser. And if you want to know more about it, please just let us know and we'll be happy to go through it with you.
I think it's worth just adding an extra point on there. Obviously, the best software in the world will still chase someone who it thinks owes money. So if you're not marking up when money comes in to say that a customer or a client has paid, then it doesn't matter how good your software is. So you probably need to look at your bookkeeping processes there. Now, again, the example of the Sparky out on the road there, they know they've been paid. They can mark the invoice up and show it's paid and send a receipt instead. It's pointless having software that chases if you're not keeping your books up to date. If you simply haven't got time, again, this might be something that you look to outsource or just make sure that you get it done. If you know your chasers are going out Tuesday afternoon at 3 o'clock, you have to get your books done by midday. So just set that target, make that an action point, and make sure that it happens.
Okay, thanks guys. There doesn't seem to be any other questions that have come through. So unless you can think of anything else you'd like to add, we should wrap up there.
I'll just finish if I can by saying thanks everyone for watching today, or if you're watching this on the YouTube channel, I hope it's been of some use. But please don't be afraid to pick the phone up and have an initial chat with whoever your account manager is here. We're very happy to give a 10-15 minute chat to anybody to see if there's some easy wins. But if you do need that extra help, we can provide that as well.
Okay, thank you. Thank you everyone for watching.
Thank you very much. Bye.
Bye.